Hello and welcome to the weekly wrap video. Just a couple of things to catch you up on from the past 5 trading sessions. Then it's been quite a volatile week, particularly on Thursday, where US equities came under heavy selling pressure, with a number of different analysts citing different reasons for the pullback in stocks. Some saying this is merely a technical correction after US indices printed at all-time record highs, with the cash S&P 500 actually breaking above 1900 for the first time in history. Others have put this down on more fundamental news flow emerging out of Eastern Europe, as the ties between the West and the East, particularly the Kremlin and Kiev, do remain very fraught as we head in towards those presidential elections in Ukraine. Now, a number of ministers do remain concerned that the Russian President Putin could potentially cut off gas flows via the Ukraine and into Western Europe if Kiev do not stand up to Moscow and pay their gas bills, which do amount to up to billions of dollars. And as we all know, Kiev are not exactly flush with cash at this point in time. Nonetheless, though, the downside in stocks has buoyed fixed income, not just in the US but across the globe, as Treasury yields have fallen below 2.5%, marking their lowest levels since October of 2013. But much of this rise in fixed income is not just due to the fall we've seen in US stocks, as ECB policy does remain at the forefront of investors' minds. That's as ECB sources earlier in the week did say they're putting together some sort of package of policy options that could take place as soon as the June meeting, which will not just involve a package of rate cuts, but also credit easing in the form of potential asset-backed securities and an extension of full allotment via LTRO operations. So see that how that pans out towards the June meeting, not next week, but the following week after that. One more final thing worth covering is the fall of the euro this week. This has been allied with a bit of a correction in these peripheral yield spreads. So after falling to record lows in terms of the Spanish and 10-year yields, these are somewhat reversed heading towards Friday's close, as analysts and markets do remain slightly concerned in towards the sustainability of the peripheral European bond rally. As we head towards next week, though, there are a couple of risk events worth keeping your eye on. First of all being the FOMC minutes, but also the Bank of England minutes after the quarterly inflation report this week did show the Monetary Policy Committee still remaining relatively relaxed in regards to rate tightening, which did cause futures markets to push back their expectations of the first 25 basis points hike from the Bank of England, but that still is priced in for the first quarter of 2015. Nonetheless, we'll bring you all of next week's releases as soon as they hit the wires, as well as any other relevant commentary to your trading. But in the meantime, that's all from me. Make sure you have a fantastic weekend.